everyone, this is Harshita here and I am going to present stock pitch report on Bank of Baroda. I carried out fundamental analysis, ratio analysis and equity valuation on Bank of Baroda. Here are some of the key values related to my company. Its market capitalization in rupees crore is 24535.75, 52-week low high is 429.95 and 899 respectively. Its book value is 756.64, current market price is rupees 581.25 and face value is rupees 10. 52-week low high means the maximum and the minimum value it has reached in the last 1 year. Then I carried out SWOT analysis on my bank and got to know about its strengths, weaknesses, opportunities and threats. Potter's analysis was also applied on the banks, from where I figured out that bargaining powers of suppliers and customers is comparable, threat of new entrants is not very high, then competitive rivalry is very furious, and availability of substitutes is fairly present. Then studying the effects of recession on Bank of Baroda. Bank of Baroda, like all other Indian banks, not only survived but also emerged as a stronger bank. As we can see, the stock prices reached a major peak in 2008 and thereafter they continued to increase. Some of the key ratios were found out for Bank of Baroda and its competitors, from where I saw that the asset turnover ratio and loans turnover ratio is very low for Bank of Baroda, which it needs to improve. Also, non-performing assets rate percentage is fairly high for Bank of Baroda, which is not at all a positive sign. Then I moved on to valuations, for which I calculated the cost of equity, WACC and G, the values of which are shown on the screen. I applied dividend discount model to calculate the intrinsic value of the share. But as we can see that there is a term in the denominator RE minus G and my G is greater than RE. Therefore, DDM cannot be applied. Then I moved on to FCFF and FCFE. FCFF is EBIT into 1 minus tax rate plus depreciation minus capital expenditure minus change in working capital. And FCFE is FCFF minus interest into 1 minus tax plus net borrowings. Cash flow is FCFF divided by WACC minus G. Now, as we can see, WACC is less than G for Bank of Baroda and therefore I get a negative cash flow value, which restricts me from using FCFF and FCFE. Also for banks, cash flow is not an appropriate method for valuing it, as cash flow for a bank cannot be found out very correctly, says research. Then moving on to residual income model, I found out the residual income to be 10.02 crores and intrinsic value of my share to be rupees 761.8 and market value rupees 554. As we can see that the intrinsic value of the share is greater than its market value. Therefore, the stock is undervalued and it's a buy. Thank you.